Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation Practical Question 4. So the H Limited agrees to buy over the business of B Limited effective 1st April 2012. The summarized balance sheet of H Limited and B Limited as on 31st March 2012 are as follows. They've given balance sheet of both H Limited and B Limited, and H is acquiring B. H proposed to buy out B, and the following information is provided. The weighted average post-tax maintainable profits of H Limited and B Limited for last 4 years are given. 300 crores for H Limited and 10 crores for B Limited. Both the companies envisage a capitalization rate of 8%. Hence, using this rate, we can find out the enterprise value or the business worth. If we just divide this 300 divided by 8%, we'll get the business value of H Limited, and 10 crore divided by 8% will give us business value of B Limited. Now H Limited has a contingent liability of 300 crores as on 31st March 2012, and the balance sheet is also on 2012, so they have a contingent liability 300 crores. H Limited to issue shares of 100 each to the shareholders of B Limited in the terms of exchange ratio as arrived on a fair value basis. Please consider weights 1 and 3 for the value of shares arrived on net asset basis and earnings capitalization method respectively for both H Limited and B Limited. So this para says for the acquisition of B Limited, H Limited is not giving any cash or something, it's giving its own company shares, but in the ratio there should be some exchange ratio, right? Let's say for B Limited here they have 6.5 divided by 10, if we put 0.65 crore means 65 lakh shares are there. So to acquire those shares, how much shares H Limited from its shares it has to give? In this case 350 divided by 100, 3.5 crore shares are there. So how much shares of H Limited has to be given to acquire the B Limited? That's what we are going to find out. For that they have given each to the shareholders in terms of exchange ratio as arrived on fair value basis. That fair value for the exchange ratio, as I told, right, how many shares of H Limited has to be given to B Limited, that exchange ratio is based on fair value basis. For that they are telling please consider weights of 1 and 3 for the values of shares arrived on net asset basis and earnings capitalization method. So we have to first calculate the value per share based on net asset basis, then earnings capitalization method, then we have to keep for net asset basis 1 and then for 3, then multiply to that per share, divided by 4. This is the weight has to be given. Based on that, whatever value is coming for H and B, so B Limited shares we are acquiring, right? So B Limited divided by H Limited's that fair value will give us the exchange ratio. Now you are required to arrive at the value of first net asset value method. Anyway, we need to calculate that exchange ratio. For that, net asset basis is required, so they are asking the same. And then earnings capitalization method, second requirement. Third requirement is that exchange ratio they are asking. That's it. Yeah, so let's go to the solution now. So net asset value is nothing but the total net assets divided by the number of shares will give us the net asset value per share. That is what required for exchange ratio also. Here net assets is nothing but 1300 is the assets, and in case of B Limited 31.5 crores is the net assets. Because it's all net fixed assets, net current assets only, so we have to, the net assets will be 1300. But if we see H Limited has a contingent liability of 300 crores, so this contingent liability has to be reduced because there is no other liability here. This all are equity shareholders portion, hence need not be reduced. Net assets is nothing but all the total assets minus liabilities, right? There is no liability here, but if you see there is a contingent liability of 300 crores in case of H Limited. There are two assumptions here. One is we have to see the materiality of this contingent liability, how possible it is to occur in the near future. or will the company be paying it or not? Here ICAI has taken a stand of the contingent liability will materialize as its full cost. Means what? 300 crores of liability H Limited will incur and has to be paid by the company. Hence, if it is paying this 300 crores, then its net asset will come down, right? So 1300 minus 300 will give us 1000 shares, 1000 crores. That will be the net assets. Why this assumption? Because in general scenarios, let's say even if we are acquiring a business, we will be doing the due diligence and all, and then we will be checking the worth of the business. While checking the worth of the business, we will be checking how much liabilities are pending or yet to be paid, or what are the liabilities in near future it will come, and if some pending lawsuit, or if any bank guarantee is given, or if any tax dispute is going on with the departments, then obviously the investor who is going to invest, they'll obviously reduce the value of the business to that extent, because nobody wants to pay this liability after acquiring the business. And many cases, if the outcome is so huge, then the investment only will not happen. So that's why they have this contingent liability also they have materialized to its full extent. Okay, so 1300 minus 300 divided by 3.5 will give us 285.71 is the per share value of H Limited under net assets method, and for B Limited it is 48.46. In case of earnings capitalization value, this is nothing but, as I previously told, how much ever is the weighted average post-tax maintainable profits, in our case future maintainable profits, divided by the capitalization rate. So 300 divided by 8% will give us the enterprise value. Then dividing it by the number of shares will give us per value, earnings capitalization value. So in case of H Limited it is 1071.43, and in case of B Limited it is 192.31. Fair value, as in the problem we have previously seen, they told us to consider the weights of 1 and 3. So H Limited 285.71 multiplied by 1 plus this 1071.43 multiplied by 3 divided by 4 will give us the weighted average value of H Limited. So this 875 is the weighted average value of H Limited per share, and then B Limited 48.46 multiplied by 1 plus 192.31 multiplied by 3 divided by 4. This is weighted average per share value, per fair value of B Limited 156.3475. Now to acquire this 156.3475, H Limited's value is 875. So 156 divided by 875 will give us, let's say multiplied by 1, will give us the exchange ratio, which is nothing but 0.1785. So H Limited should issue its 0.1785 share for each share of B Limited. What does this signify? For every one share of B Limited, the shareholder will receive 0.1787 shares of H Limited, which is 100 each. So this much as he will receive once we acquire the B Limited. That's it. Thank you.